Hello and welcome to Cashflow Positive, your go-to channel for all things finance. We're here to guide you on a journey through the intriguing world of money matters. From expert tips and strategies to fascinating facts that will tickle your financial curiosity, we've got it all. Our mission is to help you navigate your way to financial success, one video at a time. Today, we delve into the world of stock market investing and how you can build long-term wealth. To start with, understanding the stock market is crucial. The stock market, in its simplest form, is a marketplace for buying and selling shares or stocks. Imagine a bustling marketplace, but instead of fruits and vegetables, traders are dealing in shares of public companies. Each share represents a tiny ownership stake in a company. When you buy a share, you're essentially buying a piece of that company, hoping that it will grow and become more valuable over time. But how exactly does it work? Well, it's all about supply and demand. When a company first decides to sell shares to the public, it holds an initial public offering, or IPO. This is when the price of a share is determined for the first time. After that, the price fluctuates based on how much people are willing to pay for it. If a lot of people want to buy a share, the price goes up. If more people want to sell than buy, the price goes down. Now you might be thinking, why should I invest in the stock market? The answer lies in the power of compound interest. By investing in the stock market, your money has the potential to grow exponentially over the long term. In fact, historically, the stock market has provided a higher average return than other types of investments. However, it's important to remember that investing in the stock market is not without risks. The value of stocks can go down as well as up, and you could lose some or even all of your investment. This is why it's crucial to do your research and consider seeking advice from financial professionals. In the end, the stock market isn't about making quick money. It's about investing wisely and patiently with a view to the long term. It's about understanding the companies you invest in, believing in their potential for growth, and sticking with them through the ups and downs. Remember, the stock market is not a gamble, it's a tool for building wealth. Starting your investment journey might feel intimidating, but it needn't be. The world of stocks and shares might seem like a labyrinth at first, with its jargon, graphs, and percentages. But once you understand the basics, the landscape becomes a lot less daunting. The first step to getting started is research. The stock market isn't a casino where luck determines your fate. It's a platform where knowledge and planning can significantly increase your chances of success. Understand the companies you're investing in, their financial health, industry trends, and market conditions. Remember, information is power in the stock market. Next, you need a plan. This isn't just about which stocks to buy, but also about how much you're willing to invest, how long you're planning to stay invested, and what your financial goals are. A well-thought-out plan can guide your investment decisions and help you stay focused during market ups and downs. Now let's talk about the concept of a diversified portfolio. This means spreading your investments across different types of assets and sectors. Why is this important? Well, it's like not putting all your eggs in one basket. If one sector or asset class performs poorly, others might perform well, balancing out your losses. Diversification can help manage risk and potentially enhance returns over the long term. Speaking of risk, it's crucial to understand your own risk tolerance. This is a measure of how much financial risk you're comfortable taking. It's influenced by factors like your age, income, financial goals, and personal temperament. Remember, higher potential returns often come with higher risk. So don't chase returns blindly. Invest within your comfort zone and according to your risk tolerance. Strategic planning and diversified investments are your best friends in the stock market. By researching and planning, understanding diversification, and being aware of your risk tolerance, you're laying a solid foundation for your investment journey. So, roll up your sleeves and get ready to embark on an exciting and potentially rewarding journey. The world of investing awaits you. Successful investing requires strategy and patience. That's our mantra for today. Now, let's delve into some of the most effective strategies that seasoned investors swear by. First off, we have dollar cost averaging. This is all about consistency. Instead of investing a lump sum all at once, you spread out your purchases over time. You buy stocks at regular intervals, regardless of their price. When prices are high, you buy less, and when prices are low, you buy more. This method helps you avoid making poor investment decisions based on short-term price fluctuations, and over time, it can lower the average cost per share of your investments, potentially increasing your returns. Next, we have the buy and hold strategy. This is a long-term game plan. It involves purchasing stocks and holding onto them for an extended period, irrespective of market volatility. This strategy banks on the historical trend that despite short-term ups and downs, the stock market tends to increase in value over the long term. It's a strategy that requires patience, but it can greatly reduce the risk associated with short-term trading, and it has the potential to deliver solid returns. Finally, let's talk about focusing on undervalued stocks. This strategy involves identifying and investing in stocks that are selling for less than their intrinsic value. These are often companies that have been overlooked or undervalued by the market for one reason or another. Investing in these underdogs can be a bit of a gamble, but if your analysis is correct and the market eventually recognizes their true value, the rewards can be substantial. Now, it's important to remember that these strategies aren't mutually exclusive. You can mix and match, blend and balance to find the approach that suits your investment goals and risk tolerance. Remember, there's no one-size-fits-all strategy. Find what works best for you. And don't forget, investing is a journey, not a sprint. Patience, strategy, and a bit of courage can go a long way in helping you build a healthy and robust portfolio. Let your money work for you, and over time, you may just find yourself on the path to financial freedom. Building wealth doesn't happen overnight. It's a long-term commitment. Now, let's talk about a word that's music to the ears of every investor: compounding. It's the secret sauce that seasons your investment portfolio and makes it deliciously profitable over time. Imagine you're planting a tree. You water it, keep it in sunlight, and protect it from harsh weather. Over time, it grows. Not just upwards, but its roots grow deeper. It's the same with investing in the stock market. The money you invest is like the seed you plant. The patience you show, the time you give, is the nourishment it needs. And compounding is the process by which it grows. So, what is compounding exactly? It's the process where the returns you earn on your investment begin to earn returns of their own. Think of it as your money having little babies, and then those babies having babies of their own. And just like a growing family, the longer you wait, the bigger it gets. Let's put this into perspective. Suppose you invest £100. If you earn a return of 10% a year, you'll have £110 at the end of the year. Now, if you leave that money invested, the next year you'll earn a return not just on your original £100, but also on the £10 you earned as returns. That's compounding. The most exciting part is, the longer you leave your money invested, the greater the effect of compounding. It's like a snowball rolling down a hill. It starts small, but as it rolls down, it gathers more snow and gets bigger and bigger. But remember, the snowball only grows if you let it roll. If you keep picking it up and starting again, it never gets a chance to grow big. That's why patience is so important in investing. Stay patient, stay invested. That's the key to building wealth. It's not a race to get rich quick. It's a marathon towards building long-term wealth. And remember, the journey of 1,000 miles begins with a single step, or in this case, a single investment. We've covered a lot today, and we hope you found it useful. We started by demystifying the stock market, explaining its function as a platform for buying and selling shares of companies. It's a place where fortunes are made and sometimes lost. But with the right knowledge, you can navigate it successfully. We moved on to discuss the initial steps of your investment journey. The importance of planning cannot be overstated. It's crucial to understand your financial goals, risk tolerance, and time horizon before you start investing. Our discussion then led us to the strategies for success in the stock market. We talked about diversification, or spreading your investments across different types of assets to manage risk. We also touched on the importance of investing in what you understand and keeping a level head in times of market volatility. Lastly, we focused on building long-term wealth. The stock market isn't a get-rich-quick scheme. It requires patience and consistency. Remember, the power of compound interest is on your side when you're in it for the long haul. Investing in the stock market isn't just about making money. It's about securing your financial future and achieving your financial goals. It's about making your money work for you. If you've enjoyed this video and found it useful, Don't forget to subscribe to Cashflow Positive for more finance facts and strategies. Do consider hitting that thumbs up button, as it really helps us out. Until next time, keep investing and keep becoming cash flow positive.